All right, guys, this is the Tortoise Strategy podcast for October 21st, 2020. Thank you for your patience. So, we have a pretty interesting day today. I want to start with the broader view and then work down to this critical state that we find ourselves in, this blue circle. There's a lot of things going on in here that make this a really interesting moment in time. Okay. So, the 30-day look back period, that 30-day range, is 9.73% from the 30-day high made 8 days ago to the 30-day low that was made just about 20 days ago. And we almost have a perfect yin-yang action here. Look, it entered the 30-day here, sold off, gained, sold off, and now we're almost perfectly back to the entry. So you don't get much more yin yang than that. In fact, if there was ever a day lately that illustrates the four seasons and the cyclic nature of sideways markets than this, I'm not sure I specifically remember it, but just as a point of reference. Just watch how this works, man. I mean, down, up, and in. So that gives us a perfect, almost a great big zero line right here. And notice how useful that Bollinger Band mean is as this magnet that's just pulling everything along, 337, call it 338. And the RL10 does a pretty nice job of defining those turning points. It's hard to get smoother than that unless you look like at the baby dragon, which is a smooth version of the RL10, but that's pretty good. And then I want you to notice the slower moving RL30, how this acts as a little sine wave, but lagged. So it's coming into a peak, and although the extension of that slope is like this, if that RL10 keeps coming down, you can bet that thing is going to look like this. So you just notice that the RL30 takes the same form as the RL10, but it's delayed a little bit, and it's a little smoother, and the amplitude is not as great. Whereas the move to the RL30 is greater. So you have this smooth moment. So that's why these RLCO moments right in here, where that RL10 is crossing the RL30 outside of the river, really does make a difference. So those are some insights that you should gain. Now there's a reason I say that. Let's see if I can find that. This has to do with mapping theory and dashboarding and concept management and stuff. So if you think about the world as this three-dimensional space where there's a lot of things happening, and there's a certain degree of depth. You have a surface face of what's happening in front of your eyes, and then there are all these hidden layers down here where underlying concepts and theories and deep insights are happening, and what you can see is the surface, and from that you infer that there's things going on underneath at a level of depth, and you have sort of a theory of action which says all of these underlying elements down in here are operating below the surface and then manifesting as events that we can see out here, A, B, and C events happening, and they seem to be separate. But if we were to look deep and underneath this, we might see that there is, underneath, there's some kind of causal thing that is representing a relationship between all of those. And so if something changes here, then it could manifest in changes out here. But we can't see those things in the hidden layer. All we can do is try to infer that there's a relationship between all these variables. So this black box view of the world and the way the market works, we try to infer what those things are underneath, so that when we see evidence in the external world, we might say, the reason why those things are happening is because of our theoretical understanding of this. Well, how many things are there to manage in the world? An infinite number. And if there's an infinite number of n's, and the relationship between those is n to the n plus 1 or something like that, or maybe to the n minus 1, some infinitely large number of variables raised to an infinitely large number of relationships. Because if you have one thing, you got to know one thing. And if you have two things, you have to know 1, 2, and the relationship between them. And if you have three things, you got to know 1, 2, 3, 4, 5, 6, and then 7 as the integrated relationship of all of those things. So as you start adding individual elements to the network, the complexity of this thing rapidly scales. I think it's actually 2 to the n minus 1 or something like that. If my son was here, he'd slap me around and tell me what the truth is. So when we're trying to operate in this kind of world, we got to say, what's the purpose for which we are engaged? Am I trying to understand all this stuff? Or am I trying to make some money for reasons? So if I can take action in the world sufficiently successfully to make the money in order to achieve myself, I can decide which one of those things are my purpose. How important is it to understand completely everything? Like I've been squirreling around with trying to understand why, not trying to understand, but just wondering out loud, why are the treasuries behaving the way they are, and some hypotheses. And so I don't want you to think that I'm actually trying to figure out what those underlying things are. It's just something that, like a raccoon that looks at shiny things, I just notice those things, but I don't allow it to change what it is that I'm doing to try to create effective action to make money in the world, so I can apply it for purposes and reasons. So in order to be practical about this, one of the things that we can do is establish a dashboard that allows us to monitor and manage the important variables. That if there's a lot of variables down in here happening, there's a lot of variables in here, there's some kind of the Pareto principle, which says that the most important one is responsible for a great big portion of it, and then the second one is something like this. So you start getting this kind of tail, and there's some point of diminishing returns at which 20% of the variables account for, when you sum all this, something like 80% of the useful information. If you can get to 80% utility, then you can act effectively in the world. Now, with information technology, there's actually some evidence that says this might be 28% and 72%, and that this extra little bit of information can give you an advantage over the 20/80 rule. Right? So when we make that dashboard, all we're trying to do is take a look at all of this complexity in here and simply render that as a simplified concept map, a map of the territory, which has some degrees of complexity, but it has useful simplifications with respect to this world. It has enough information that I can act in the world without trying to completely understand every little thing before I act. That's analysis paralysis. And so you can decide, how simple you want that map to be. And now there's a continuum of complexities on the map in which, as you go up the degrees of abstraction, it gets simpler up to the point where it might just be a metaphor or just some heuristic rule, like the 200-day moving average in SPY and in most things, especially those that are correlated strongly. That if price is below the 200, you want to reduce risk. And if price is above the 200-day, you want to be long-term buy and hold plus leverage. And that's the basis of the simplest market classification ever. Is it true because it's true? Or does it work because it's true? Or is it true because it works? Does it work because it's true? Or is it true because it works? Yes to both of those. There is which one is the dog and which one is the tail? There is a self-fulfilling prophecy certainly involved in here, where in some population that's even aware of the rule, there's some number, some percentage, X% believe that it works because it's true, and they think there's something magical and mysterious down in here, some law of the universe that says that it turns out that the 200-day moving average matters. So, and then there's some 1 minus X% that believes it's true because it works. And the utility of both of them, I don't have to know which one is right. I just need to know that it seems to work. So far, so good. And that's why this is an element, the first element in our market classification. So the point is that this is a decision you get to make about how far up the degree of complexity you want to abstract in trying to understand this swamp of infinite variables. And you say, yeah, well, you can over-complexificate that too and say, what I'll do is I'm going to have a series of models that are situationally geared, that maybe for long-term stuff I just need this simplest one, and that as I get into other circumstances I might need to activate other. So now I need a mechanism or a judge that allows me to mix the models in some kind of effective meta model. And that's what our good friend Robert Gardner calls the mosaic. So when we talk about the mosaic and these different little pieces, what we're really doing is taking samples of this marketplace, this n-dimensional market. We're taking a sample from over here and down here and over in there, and taking those four. It's not triangulating them because it's 4 points, but we're getting some kind of integration of those. And if we can get a sampling of things going on, it may be that we have a very efficient way of anticipating these kinds of major turning points in the world, and all geared simply towards taking effective action in the world. So how do you know? Well, you got to calibrate that and say, this is the naive posture. I don't mean that in a negative sense, but that's what it's called in research, is the guy that doesn't know any better, and that's simply long-term buy and hold of the market all the time. And if that produces some curve, we want to be on that side of the curve with acceptable levels of risk and volatility and cost. And that as long as we're doing that, then at some point we're accumulating tentative evidence that says, oh, we can do better than simple naive response. So that's the ongoing research challenge of what it is that we're trying to do. I'm so glad I recorded that, because I don't know if I could say it that good again. So I say that in order to say that's why I show you that previous little diagram, that big fat thick line that took this. I don't think of it as complex, but the first time you look at this, it looks like a dog's breakfast. There's so many lines and colors and shapes and things on here, but each one has a role to play as part of that mosaic. But if you were to abstract this even further, in one sense, the MACD histogram is a dramatic simplification of this RLCO Bollinger Band framework. And that thing is just simply tracking the difference between the spine of the dragon, which is the 10-period simple moving average, and comparing that to the Bollinger Band mean, which is the 30-period simple moving average. And it smooths all that out. So it gets rid of all the price and all these other colors. And it simply looks at those two relationships. And so in that circumstance, if we were looking at the MACD histogram, that is concerned with that 10-period simple moving average, which is the spine of the dragon. Drawn approximately to scale. And the 30-period simple moving average, which is that dashed line at Z0, right in the middle of the river. And so when that the SMA 10 is above the Bollinger Band mean, that's a good thing. And, so that's in here. And when it's below that, that's a bad thing. Crap, it's not. But then you notice it's really the turning points when that dragon hump changes. That when this rolls over, that's the equivalent of fall, winter, spring, summer, and you can see that now that the hump of that dragon is forming, we're at a really important cusp, that turning point. Now, the SMA is slower and fatter than the equivalent RL, right? So if I look at this RL10, and I'm just going to color him in here, these turning points happen a little bit faster and further away from the Bollinger Band mean than the RL10. So this little peak happens a few beats sooner than the peak of the dragon. And why? Because the RL10 is faster and more volatile. So this is fast and the SMA is slow. And by the same token, here's the peak of your RL10 and here's the peak of your dragon. So this is about 1, 2, 3. It happens 4 days sooner. So when you're standing back and looking at this from a distance and you're using the MACD, all we're really caring about is really the brute force relationships between the dragon, the SMA10, and the RL30. And then if we're looking at this RLCO, we're looking at the RL10 versus the RL30. You could even say the RL10, how far does it stretch away from the middle of the river? That's actually a useful discussion too. So you're taking the fast price, the RL10, and looking at the slow river, the SMA30. So that gives you a really nice relationship. So you'll often see me calibrating the size of this move, the magnitude of the move. How far can the traders stretch the price away from the middle of the river? That's the same principle that we use in the regression line fractal framework, but I'm using a couple different indicators, but it's the same principle. The size of this downward move is how far the traders were able to stretch it away from the midpoint of the river. And then that's not surprising that that's how far they can stretch it above. Once this thing corrects and starts cruising up, how far can they stretch it on this oscillation? That distance looks like that distance. And the amount of power that the fast traders have compared to the long-term buy and holders represented by the flow of the river, well, that tells you the difference between traders and long-term buy and holders. And it's in those oscillations that we get a sense of market condition and directionality, and then important boundaries like the 10-day and 30-day high and low, this previous all-time peak high up here. Now that gives us a playing field, a box with certain constraints that's going to hold some percentage, X percentage of normal price action. So when we get breakouts from those boxes that we have constructed based on statistics, then that becomes an aha moment. Oh, something special just happened when it breaks out of that box. So when we're using the NDX and we're looking back at a 10-day NDX or a 30-day NDX, those breakouts from those trading ranges now take on a little bit more importance to us because they reflect a breakdown in what was previously the normal boundaries. So something in the underlying mechanics of things, remember we said there's probably some deep hidden level where that market engine is cruising around down in here, and all we can see are the things that are on that surface screen. So when you see these kind of breakouts from 10-day highs and 30-day lows and all that, then maybe there was some important underlying shift in these hidden variables that are driving the relationships inside the market. And it doesn't mean that these things are like there's one master conspiracy theory. It's just that there's so many variables and so many interplays that we can't even see. Like in a neural network, it's doing the computations and it's not even self-aware. That's my operating opinion, is that there's a degree of complexity in there, and now what you have is emergent behavior from such a degree of complexity that it looks orderly. Like if you look at a flock of birds that are flying, they behave as if there is some kind of corporate brain, but it really is just a collection of individual responses to their local environment that takes on the appearance of order without there being necessarily a design. So you can see elements of order happening in the market that are repeatable, but without any underlying intentional plan or deterministic model. It's really just the way that many variables get together and interact, it causes repeating patterns on the surface of things. So that's what we're using our descriptive statistics for. Our descriptive stats and models and indicators are really just ways that we can start taking a sampling of data and trying to identify things that over time seem to give us reliable rules that are robust, that allow us to be large when we're right and small when we're wrong, and to adapt as quickly in our decision making as the underlying market seems to be adapting. We want indicators and models that are as adaptive. They adapt at the speed with which the market adapts. And since the rate of change can change, we are concerned with having adaptive models, and that's the essence of hybrid trading. So that I wanted to say that so I could just get that out of my head. Let me know if you found that to be helpful. It felt pretty good leaving my head, so let's go ahead and get on with it. So our 30-day range then is about a 9%, 9.7% from high to low. Our 10-day range is about a 3.6% from the high down to the low. And that was, and this is probably co-equal in here, so. I'm noticing the peak of the RL10 and where it crossed the baby dragon. This is getting ready to change into the fall, because you can see it went from spring to summer, and then it's just about due to change. I'm noticing that our PSAR, which flipped here, it flipped from here, from here down to here, and it flipped because the RL10 crossed above the PSAR dot here, and that's why on the next bar it flipped down to here, because the PSAR is built off the RL10 and not off of price. So then I noticed how the PSAR has been working right up here, and now I notice inside this blue circle there's a lot of things going on in here. All right, we're going to notice that the come on. So we notice that the RL10 entered the dragon, crossed the spine, and emerged from the dragon today. So that is an RLXD. And we notice that the PSAR dot is right about, it was there today, it'll be here tomorrow. So tomorrow, basically no matter what, that PSAR dot is going to flip. And now that makes the long side move officially over when the PSAR dot flips. Well, we sort of knew that was happening anyway. That failure to follow through 1, 2, 3, 4, 5, 6, 7 days. It took that long for this upward motion to run out of gas. It tried once. It tried a couple times in here, and each time it could not maintain it and fell back and closed near the low of the day. That also happened today. And so now we have an RLXD, and now this is perfectly poised as a critical state to either resume here or give us the same size leg down to look just like that. So this is like a perfect storm of a critical state in here, because notice that you have a close, and another close near. So you have 3 days in a row where this close is all tightly clustered here around 343.5-ish. And when this thing breaks, if it breaks a 10-day low, then look out below. It's going to lead to the Bollinger Band mean acting like this great big magnet at 337 3/4. If that fails, then the next measured support level is down here at Z1 at 330, followed by the belly of the dragon at call it 328. Then the RL270 fair value at 327. Then the Z2 down here at 322 3/4, which also represents a 10% sell-off. So this red line here is a 10% sell-off from the all-time high, in the same way that this 10-day low right here is basically a 5% sell-off from that all-time high. So if we scrolled up, we would see this all-time high back here. It's hidden underneath that little window. I don't know if you can see it. Hold on. Yeah. There it is. So this all-time high, which was made about 35 days ago, up here, is that measured level, and we start taking a look at the sell-off from peak price. So here's the 5% sell-off line, and the second one is a 10%, and the third line is a 15%. So right now we have pulled back from that peak price, and there's the 5% sell-off, which is right near the 10-day low. So this is all tactical noise. But if this breaks, now suddenly it starts feeling like a correction. And if that breaks, and the Bollinger Band mean breaks, then we're well on our way down this stack to hit Z1 and then a 10% sell-off all the way down here. And that can happen pretty fast, as we know, because you see how fast from here. That in 1, 2, 3, 4, 5, 6 days, it fell that far. So if we went, so this sell-off was not as steep as the previous one, but it's not too far to say it could go on the second leg down. So when we start thinking about a second leg, well, why didn't it just panic sell off? Well, because of the power of this move up in here. Those guys are fighting, and they're trying to make this thing run up, but they're losing that tug of war, and now we're at a critical state to see, well, the bears got it to pull back this far to the yellow dot. Can they get a second leg? And the second leg will go faster than the first leg because they're winning. So now this is an all-important 10-day low right here. It's had 3 days where it's found support and tried to run it, but it couldn't. It kept coming back. So this is acting like a big test magnet, and we're going to find out something important tomorrow. So is it going to be a big move up or a big move down? I don't know, but it could also be, it could just keep up this little grinding business. That's the least likely thing to me, is if it stayed in this kind of sideways channel here. And if we just said something like this, using the 10-day low as our marker, and maybe I would almost say the hump of the dragon. So to me, that's what that yellow zone looks like. And as long as price is mucking around inside this yellow zone, as long as it's inside this yellow zone from here to here, then it's just noise. But so if we get a breakout above, call it 348, or a breakdown below 341, then that's where you're going to start seeing those great big directional moves. So I would just say my trade frame, based on market conditions now, would look like this. A breakout to the upside is good. and then a breakdown below the 10-day low is bad. Otherwise, it's just mucking around in the middle. Okay. So let me know if that was helpful to you. All right, let's shift to see what worked today. So the market was down. We'll take a look at this first. So the S&P was the best performing of the U.S. indexes. Those are the yellow boxes. It was down 0.2. Treasuries and diamonds were down 0.35, so a third of a percent. And then the Russell, ominously, down 0.9. So that's not good. When the speculative thing is pointing down, and even the defensive plays were suffering, that's not good. So let's see the sectors that underperformed today. So again, the market at 0.2, EWZ Brazil was at about 0.2, minus 0.2. The two techs, the triple techs, were at minus 0.3. Not much to choose between them. Materials, commercial real estate, healthcare, finance, all down. So a broad base of weakness. Consumer discretionary, minus 0.55. Energy, oil, exploration, and clean energy took a big hit today, minus 5%. Then you had Virgin Galactic, minus 11. Devon Energy, minus 3.8. Oil, 3.3. Goldman, Boeing, DuPont, Amazon, Caterpillar, NVIDIA. So lots of big names, even some broad tech leaders in there like Amazon, NVIDIA, Apple, Cisco, all underperforming the broad market. To the upside, again, we have the S&P at minus 0.2. Tech was marginally better at minus 0.15. Ackman's hedge fund, 0.12. Emerging markets, 0.3. Mexico, the FANGs, and Japan between 0.8 and 0.9. Wheat and precious metals and silver, 1.2 and 1.4. Best performers, Twitter, 8%. They broke above and held above 50, and we've got them from 28, and that's a long-term keeper right there. That's the only thing we have protecting democracy right now is 288 stinking characters. And so now the biggest issue, in my view, for democracy is censorship policy on the socials, but especially on Twitter, because that's the digital free marketplace of ideas and words and First Amendment. I think that's got to become a public utility, and I think that stock improvement is starting to reflect that. So own that for the long run. I'm buying that one for my kids. Oh, interesting note. In passing, PayPal announced today they're going to accept Bitcoin and allow you to buy Bitcoin and hold it in your account in PayPal. So almost acting like a little bit of a brokerage, but also using it to pay for goods and services through. But so there'll be a tactical transaction. But the fact that you can buy it easily on a major platform like that, pretty important moment. And Bitcoin drove to the highest price since early 2019 today on that note. So anyway, Twitter, big day. Nikola Motors intraday, nice moves. Now some of our metals, Alcoa 4%, Cliff 2.7%, U.S. Steel 1%, Procter & Gamble just cruising along at 0.5%, Walmart, Tesla, Intel. All right, a quick look at trades that worked. All right, Cliff Natural Resources. So this was yesterday. And I want you to note, if I roll this back a little bit, you'd see where price, let me make that blue, sorry. If I rolled that back, you would see where you would see where price was right on the VWAP. And then in the afternoon, that as it went into the close, that thing just drifted down on very low volume, and it created this moment, this peak stretch of price away from the VWAP. So that becomes an important price level for tomorrow. So we would kind of draw this little rascal right here and say this price level is important tomorrow. And then there's a gap down, and then it immediately starts taking off. So when it moves off this swing low, one of these minimum manageable risk boxes that we identified at the Z3 pinch yesterday, so when it moves that far off the low, which turns out to be just 5 cents, that's a buy with a stop here. Then right about here, you get the Wu Wei exit and no lose plus dinner for 2. And you ride that all the way up to either a sniper exit or the managerial exit at $8.10, which is 25 cents on a 5-cent risk. Doesn't seem like much, but that's 5R. Now, this is kata number 2, right? I want you to see this. You have a swing low in the RL10. You have this double swing high in the RL10, and you have a swing low. That makes this RLXD even better. So that's the second position, and you've already made bank on this much, and your stop is here anyway on the first position. So even if this hits your stop, you're not losing any money on that trade. And so now you get a second position, you get a little extra taste. Now, you also have another kata 2. You have a swing low, you have a swing high, you have a higher swing low. So this is, if we were marking this up, we would say this is 1, 2, 3, and you buy the RLXD, but this one doesn't follow through, so that's a scratch. When it comes back and hits the Bollinger Band mean, I just took the scratch. And then that became a collapsing dragon here, because now you'll notice that when it violates the RL10 and the hump of the dragon right there, that's an auto short. And then this thing ended up coming, not only stopping here, this thing came all the way back to 785 and gave this kind of a move in the afternoon, which made this entry here, this dragon short, nice. And there was another opportunity to get another collapsing dragon in here on the way down. So this is a place where I want you to see that the drift down in the afternoon away from the VWAP creates the conditions for an early correction, a low risk trade, kata 2, second position, cash about 6R, re-enter, doesn't work, scratch. And now we've got the RL90 rolling over, the dragon rolling over, collapsing dragon, bang, and there's another 3 or 4R hidden inside there. Okay. Next one up. This is kata number 2 on Nikola. This is another one that finished strong all day. And I want to just show the kata form of this thing now. So you have 1, 2. Notice it resisted crossing the VWAP there. So there's the peak of the RL10. And then it reverses once more. So you have a 1, 2, 3, and go. And now you have a 1, 2, 3, and go for your second position. And then you just take the managerial exit here when the Bollinger Band mean takes it out, right? So there you are. This was a supported spring crossing in the yellow dot, but I wanted to just highlight the kata 2. So here's 1, 2, 3, and go. And then it peaks here, and then there is your managerial exit. And so this is an entry at about 22.40 and out at 22.90, so that's 50 cents on about a 20-cent risk, if that much. So it's maybe this one here is this one here is about 2R, and this one was probably 4 or 5R. Just trading kata 2. Here's DIA. This was a morning sell-off, gap down, hybrid frog move off the bottom. Here is when it goes, let me get my arrow on here, sorry. So if here's my entry, here's 1, 2, 3, on the fourth dot above, the fourth PSAR dot above my entry. That's where the exit moves up, and it happens to land right on the Bollinger Band mean. So just take your exit. So here's your risk. Here's your risk box there. So that's about 1, 2, 3R to here. Here's your collapsing dragon when this thing breaks below the VWAP and you get a Z3 breakdown. Here's a second collapsing dragon. Here's a third collapsing dragon and a supported spring crossing exit. So this is just massive goodness. I mean, it's massively good. That's 23 or 83.75 to 82 and a quarter. That's $5.50 on a 50-cent risk. If that's not even 50 cents, probably 30 cents. But call it 50 cents. That's 11R from here to there. No, I'm sorry, that's wrong. 283.75 to 82. That's a bucket. Oh, that's better. That's 3R. Sorry, miscalculated. So that's 3 plus 2 and a scratch. So that's 5R on a routine retracement. And all you did was you have this perfect yin-yang. Sun rises in the morning and sets in the evening. So, of course, you change with the setting of the sun. And then you have the supported spring crossing exit that got you out of this nice trade, gets you into this trade. And there's an R, maybe 2, on a managerial exit. You get short, you scratch, stop and reverse, and you make probably one more R. This one faded pretty quick, but so there's probably 6 or 7R just in DIA, intraday, no directional bias, just following the routine oscillation of those sine waves. Just trying to ride those waves. That's all. I mean, that's what that is. Kata 2, kata 3. All right, let's get through the daily report here. Preparing my doctoral classes. They start tomorrow. Let's see. If you're experiencing lower back pain or energy blockages, I look for a thing called the Chi machine, CHI, on Amazon. It's about $150. Holy mackerel. In 3 days, that has loosened up my lower back, which I strained doing some over enthusiastic weightlifting. I was doing overhead presses without a support belt and strained my lower back, and it's been bugging me for a couple of weeks. And 3 days on that little inexpensive machine, gentle, passive massage and rotation. Holy cow. I can't give it higher marks than that. I just bought a second machine so I could have one in the basement so I don't have to even walk upstairs and use the girls. They would rather I didn't use their machine. So that's gratitude for you. Don't let them hear me say that, okay? Let's just keep that between ourselves. All right, all right, let's look at the daily report. We've already seen the market health check. Oops. And we are still bullish normal. Let me let that come up on your screen. Okay, bullish normal. We're basically oversold on a 10-day, weak on a 3-day, but otherwise above average. ADX is a non-directional 15. ATR percentage still normal at minus 1.6%. The risk Z is now rolling over. It did not give us the big follow through to the upside that we'd hoped on the second leg up, but is starting to hint towards weakness as we get to election shenanigans getting dumber rather than smarter. Got a handful of channeling rules where all of these indexes are above their 200-day moving average, but then went oversold today on Williams percent R. When both of those rules fire, you get a signal, and the symbol turns green. So EPP, the Russell, Tech, and the S&P. There's the 10-day min pains are the ones that have sold off the least from their 10-day high. Max pains are the ones that I look for signs of real weakness and suffering the most under the sell-off. So there's some good names in there. Apple, Chevron, Devon Energy. Dow Tactical Summary, still quite a few dojis today. Let that come up on your screen. Lots of good auto framers to choose from, and some big breakdowns in the NDXs today. The lag is getting bad. There we are. So lots of dojis. Many auto framers test out well. We're actually getting this reduced volatility is having a lot of frog quality numbers better than 3, so that's worth looking at. And then the NDX is showing a lot of things that broke down over multiple time frames today. The only one that bucked that trend that might be interesting is taking a look at Travelers, which had the big breakouts for today. All right, next up, the ETF 30. All right, so we have, again, a lot of dojis today and a handful of channeling symbols. Got some good auto framers. Test out well on the return to the 10-day high. Only a couple breakdowns on the ETFs today. And we saw weakness across the board in energy. So that's oil, XLE, and XOP. And then the defensive plays gold, silver today, and then Mexico and silver. Mexico and Latin America and Japan did well. A lot of good names on the auto framer to choose from, testing out better than 2-1. There's treasuries are in there. Apple is in there. Tech and energy are in there, along with Microsoft. So I like those. Next up on the daily squeezes, still some really good names that are ready to make one-day big moves. There's Apple, Technology, McDonald's, and Merck are in the stack. Microsoft is close to the threshold at 1.8. The weakness is now causing a lot of symbols on the MACD Four Seasons to roll over into the fall. You see that both in the ETFs and in the Dow. So those are going to be the ones that are failing faster. The ones that are still in the summer are doing pretty well. And then you'll notice that the defensive plays, Treasury, silver, gold, are in the spring and moving up. Microsoft has moved into the spring and moving up. I like that one. And last chart we'll look at is the multi-time frame NDX. You'll notice that Travelers had a great big day today on every time dimension. Silver, gold, and Mexico had big days today. But otherwise, it was gloom and doom up here in the bright red areas that are showing real weakness. So those are the symbols that are really suffering the most. And then in the so a lot of suffering going on in there. All right. So plenty of things to be ready for tomorrow. Again, until we get through the election, it is tactical trading, in my view. Bird in the hand, worth two in the bush. You should be using these opportunities to really master kata number 2 and 3, that second leg up, seeing the higher lows and buying them in the pocket with a tight stop, and bird in the hand is worth two in the bush. These targets they're running like salmon in the spring. Or maybe it's the fall, whenever they spawn. That's my strong advice there. Okay, so that's everything I got. I'll get this published and posted. Let me know if you found that opening segment about market theory and whatnot helpful. That little brainstorming and whiteboard session. Take good care, guys. We will see you in the chat room.